Taxbit is the leading tax and accounting compliance platform for digital assets. It is a platform designed by CPAs and tax attorneys to simplify compliance and reporting. And with me is Lindsey Argalas, the CEO of Taxbit, who's joining us as part of the Markets on Chain series brought to us by the Global Blockchain Business Council. So great to have you here.
Thank you.
Now, tokenization has been, of course, a huge topic lately, and it's often framed as a technological innovation. Where do you see the real commercial inflection point of tokenization, and which asset classes are likely to be the most likely to drive this forward?
Yes. Yeah. As you've mentioned, tokenization to date has been technology innovation, right? It's been very focused on the experimentation. How do we use blockchain to help modernize the financial infrastructure? But we are starting to see greater adoption of tokenization. Last year, for example, the total market of tokenized real-world assets was $33 billion. That is expected to grow to over $16 trillion by 2030, right? So tremendous forecasted growth we expect here as institutions start seeing the benefits of tokenization. The concentration thus far has been really in government debt. So treasuries, various funds tokenized, some of the large institutional players leaning in there. Why? Those are well understood spaces, highly liquid, low volatility, standard financial instruments. Increasingly, there is interest in tokenized equities, particularly from the large crypto exchanges, offering people globally access to equities that are otherwise not available to them, right? So if we think about, Apple, Tesla, some of the very large, expensive ones, the fractional ownership that tokenization allows brings in an element of accessibility. In addition to that many people outside the United States can't access or invest in those equities today. So the innovation of the technology around programmability, fractional ownership 24/7, and the global nature is very interesting in terms of driving the next wave of tokenization innovation.
Absolutely fascinating. And it's going to be so interesting to see this unfold, because I feel like it's starting to really gain steam.
Yes, absolutely. Yeah.
Now, stablecoins, of course, a big part of this, and they have moved beyond crypto trading now into payments, treasury, settlement. What needs to change from a regulatory and accounting standpoint for large enterprises and banks to treat this as, stablecoins as financial rails?
Yes. So again, similar to real-world asset tokenization, which has been a very large topic of late, stablecoins have really been the breakout use case, right? I look at stablecoins as something now the institutional players are seeing. Again, there's real benefit of the underlying technology to help modernize the financial infrastructure and being a little bit of this bridge between digital assets and historical crypto trading activity and modern financial services. So last year alone, for example, there was an 80% year-on-year growth in stablecoin volume. We're now at about 35 trillion in volume. Of course, that is very small in scale to the broader financial market and payments volume. Interestingly enough, we see a lot of interest, right? There's been experimentation. People are seeing the benefits of it. In a recent Deloitte survey, 99% of CFOs of large enterprises anticipate that they will use stablecoins in some form or fashion in their financial operations here in the coming years. That said, only 10% of that stablecoin transaction volume today is for real-world payments. Okay, so there still is a lot of growth to be had of stablecoins becoming payment rails. Why is that, right? It is no longer a blocker of the technology, right? We have great companies that are enabling stablecoin infrastructure. It's no longer an issue of liquidity. There's a lot of players, again, that have offering deep liquidity in stablecoins. It's really around three things. One, stablecoins are cross-border, right? They're borderless. That's one of the inherent qualities and benefits of them. The challenge is you still have emerging regulatory frameworks, right? The interoperability across markets is still evolving. So that is one. Secondly, the intersection points of stablecoins meeting the traditional financial infrastructure, the on and off ramps, right? That is still immature and is a focus for making those systems work together. If you think about the benefits of stablecoin being 24/7, 365. Those are incongruent still with the traditional banking system and legacy infrastructure, right? So there's a lot of work on the modernization there.
There's still some challenges as all these parties kind of learn to talk to each other.
Yes.
But now there is a perception that regulation slows innovation. And I think everybody knows we need both,
Yes.
right? So from your perspective at Taxbit, how is compliance actually accelerating adoption for stable coins and tokenized assets?
Yes. You're right. I think compliance obviously does slow innovation initially, right? Because you need to have some guardrails in place. The thing that we're seeing, though, is compliance as it comes into fold and regulatory clarity and safe guardrails, of course, is what enables and accelerates adoption, right? It helps bring this wonderful innovation into the mainstream. And that's what we're seeing is a really important part of that. So it gives regulatory clarity, it gives more certainty, it gives investor protections, it helps preserve market integrity. Those are all very fundamental things to make players that are either Fortune 500, large regulated financial institutions, participate in this new innovative technology versus having some of the historical kind of crypto native players that have innovated on the side. The compliance really is the thing now that you have digital asset regulations that are taking inspiration from financial services regulation, trying to also learn from lessons in the past, right? Around how do we keep a financial system safe? How do we integrate this innovative new technology into the financial system, but at the same time, really allow the innovation to flourish?
Sure. And both sides need to work together.
Absolutely.
I feel like the regulation that we got in 2025 was absolutely accelerated the industry.
Exactly. Yes. Just maybe on that, you're right. The from to post the Genius Act in the United States for stablecoin adoption has been pivotal, right? So that has been a really important thing, which gives the CFOs, the boards, the risk committees comfort to start engaging with stablecoins. We have a lot of engagement right now, both from crypto native players as well as large scale financial players on the Clarity Act or the Market Structure Act. You have the Financial Stability Board globally, right, that is working with parties across countries around the world, trying to harmonize the regulatory standards of the compliance standards. Again, bringing the digital asset regulation and compliance standards to be more in line with financial services, whether that's on AML, transaction monitoring, reserve requirements, et cetera. And that's all really important piece of it. Taxbit is focused on the tax reporting, which has been historically a very complicated matter, particularly across multiple markets. And we are focused on how do you automate and simplify the complexities for clients that want to engage in this new technology.
And there's a lot of regulation going on globally. There's, of course, MiCA in Europe.
Yes.
There's legislation in the U.S. that some has been passed, some is still in the process. Licensing regimes in Asia. So how can global companies build compliance strategies at scale across all of these countries and not slow innovation?
Yes. That is, again, one of the inherent qualities and appealing characteristics of digital assets is that it's borderless. And the majority of companies that are engaging with digital assets are also in multiple jurisdictions. You are right. It is a fragmented regulatory landscape. You do have regional and some global regimes. So as you mentioned, MiCA in Europe, for example, or in our space, in tax reporting, the CARF, the crypto asset reporting framework across 70 countries. You have a lot of regulation that is coming into effect that are setting standards, which is helpful. But at the end of the day, all of these things get transposed into local law and local rules, which make it challenging for the companies to comply. So a couple things that global companies need to keep in mind as they operate cross-jurisdictionally. One, of course, is just anticipating and recognizing, despite the regional or global frameworks, there are many local nuances that need to be taken into account. And so we have seen several players that have received, for example, their MiCA license in one jurisdiction in Europe that have to take on new requirements to operate in other parts of Europe. So this notional passporting, for example, when practically it comes into effect, the teams have to be very cognizant of there are many local differences. The second thing to prepare is really just to work with trusted partners and vendors, right? That could come in the form of advisory, local legal counsel, and then technology service providers such as Taxbit, right? We are focused on the tax reporting, helping automate all that complexity of tax reporting compliance. And there are many other, great companies that are focused on automating and using technology that is fit for purpose for digital asset compliance across all of these jurisdictions.
Yeah, interesting to see if AI can play a role in streamlining that as well.
Absolutely. And I think, again, AI, particularly in compliance fields, needs to be very thoughtfully incorporated. But absolutely, we are using it in a very careful manner to help us automate the complexity so that our clients can operate in over 70 jurisdictions and be compliant.
Now, looking ahead 3 years, what will distinguish digital asset companies that successfully integrate into the mainstream financial system from those that do not, particularly in how they approach compliance and transparency and reporting?
Yes. I think the winners in this next phase of digital assets won't be the ones that speculated on crypto prices, right? That has been a historical thing. It will really be the companies that thoughtfully use the technology for innovation to operate better and integrate it with proper financial system and operations, right? And that's what we're already starting to see. In a recent study, 1 out of 4 CFOs plan to use crypto in their financial operations, whether that's stablecoin for treasury purposes, et cetera. And that number is higher when you look at the very large global enterprises. Similarly, 76% of institutional investors plan to engage very thoroughly in digital assets and crypto. And so the exciting thing, I think, for us is that you see crypto and digital asset no longer as a side activity, but really this convergence of bringing that power of the innovation and potential to help modernize the financial infrastructure. And so we believe the winners are going to be ones that are focused on that convergence to really help modernize the way that historically the capital markets or financial operations have played out. And compliance, of course, is a really important part of that, right? As we look to keep the financial system safe, as we look to give confidence for the largest players to engage in the space and for regulators to also get comfortable, we have to have compliance, transparency, auditability to make sure that everything, is being done properly and that we have the right uses of that great technology and digital assets.
Okay. It's going to be very interesting in the next few years to see all this. Lindsey, thank you so much for coming in and explaining Taxbit and being a part of the Markets on Chain series with the Global Blockchain Business Council.
Pleasure.